Hello and welcome to the Charter Hall Direct Insight series. I'm Steve Bennett and I'm the CEO of the Direct business at Charter Hall. I'd firstly like to begin today by acknowledging the traditional custodians of the land on which we each gather today and pay my respects to the elders past, present and emerging. And thank you all for joining me for this update on Charter Hall and our Direct suite of funds for the December 2021 quarter, which was a very busy period for the team and the property funds. During the quarter, all properties across the Direct suite of funds were independently valued, and pleasingly, all funds continued to produce above benchmark performance in the 12 months to 31 December and delivered strong across the board returns for our investors. Over the year, industrial and logistics and long WALE retail assets performed particularly well given the strong sector and underlying tenant fundamentals. The office market is proving resilient, and despite the arrival of the new COVID-19 variant, Omicron, we expect high vaccination rates and reduced lockdown restrictions to boost tenant and investor confidence over the medium term. But wait, I will be providing more valuation insights later in today's presentation. During the quarter, our office funds DOF and PFA completed A-grade office acquisitions in the Sydney and Canberra CBDs respectively. Furthermore, in the last 12 months, both funds have benefited from a substantial combined investment of over $350 million from the Charter Hall Group, providing strong strategic alignment. Our diversified fund, LWF, and industrial and logistics fund, DIF4, also acquired properties throughout the quarter, which I'll be talking to as well in today's presentation. And today, our guest speaker is Sheridan Ware, Charter Hall's Chief Information and Technology Officer. I'll be talking to Sheridan about the increasingly hot topic of property technology and how Charter Hall is navigating this area, and importantly, what does it actually mean for our funds and investors? And finally, from everyone in the Charter Hall Direct team, we'd like to thank you for your ongoing support, and we look forward to delivering positive results in 2022. So before I begin today's formalities, I should highlight there'll be a Q&A at the end of today's presentation, where I will be answering a number of pre-submitted questions. Unfortunately, there is no live Q&A. However, if you have questions, please do include your preferred means of contact, phone number or email, and someone from the team will definitely be back in touch to cover off your queries. I'd also like to remind you that we are not able to provide financial advice. Today's information is an update on our funds and the market more generally. But if you have specific queries that relate to your personal investment situation, we always encourage you to consult your financial advisor and read both the product disclosure statement or the information memorandum in full. The agenda for today will follow a similar plan as what we've previously done at these quarterly reports, being an update on the wider Charter Hall Group, a bit of information on how the respective funds have performed over the last quarter, 12 months and since inception, but I'll also be spending more time today on some of the case studies around the acquisitions and explaining why we targeted those assets for the funds. And finally, we'll be wrapping up with that interview with Sheridan Ware later on in today's session. So where is Charter Hall Group positioned? And remember, Charter Hall is the manager of these funds that many of you have invested into. We continue to be the largest owner of Australian commercial property in the country. Our focus is on high quality tenants across the board, as well as you can see on the chart, the focus on long WALE assets. So regardless of the sector, we like to focus on those income streams which are secure. The Direct suite of funds, you can see in that chart with the donut, over $10 billion of funds under management. And you can see in the top chart, Charter Hall manages over 1,500 properties. Because we get regular independent valuations and almost the entire 1,500 was independently valued at 31 December, we also have fantastic insights to trends around valuations of not just specific assets, but sectors that are also playing out. So I'll now provide a little bit more information on the Direct team at Charter Hall. And this is the team that manages your investments on a day-to-day basis. We now have over 20,000 investors across the suite of funds, 1,500 financial advisors who are regularly writing business, 6 open funds, so investors and advisors can choose the product that best suits the individual client. We've won 2 recent awards, which we're very proud of, being the Zenith and Money Management Awards. We have 21 team members spanning the skill sets of investor relations, funds management and investment management, as well as the business development side. We have over 124 properties across the portfolios, And in the last 6 months, we acquired $1.2 billion of assets, which had a weighted average rent review of over 3% and a 99% occupancy rate. So as is traditional with these quarterly updates, the first thing we cover off is how are the funds performing. You can see up there on the chart, there are two benchmarks. The direct funds benchmark in grey at 12.3% and the Maxim benchmark, which is for our listed AREIT investment vehicle. You can see here that all the investments exceeded the benchmark over the last 12 months. In fact, Maxim outperformed by over 4%, delivering a 31% return versus a benchmark of 27%. That's a fantastic result for investors. And all the direct investments, starting from DOF, LWF, PFA, DIF4, and WPS1, all materially outperformed the benchmark. In fact, the lowest return over the last 12 months was DOF at 15.4%. But when I'm talking about performance, I always mention that you should focus on the medium to long-term investment horizon. And that's because unlisted properties should have a 5-year plus investment term. You can see up here on the slide, we've shown the performance since inception. The grey bars are the benchmarks and the blue bars are the returns of each underlying fund. The reason why the benchmark differs in this case is because it changes depending on when the fund was launched. The blue bars, as you can see, every one of our open funds has materially outperformed the benchmark over a long period of time. So this isn't 12-month returns. In some cases, like the Maxim fund, this is the returns over a 10-year time horizon. But pleasingly, all funds continue to outperform. So far I've talked through the performance of the funds that are open for investment. But we are aware that many of you tune in for updates on the funds that are closed, being BW Trust, DIF2 and DIF3. This slide shows their performance since inception. And again, even the closed-ended funds, which you unfortunately can no longer invest to, have materially outperformed the benchmark. BW Trust benefits from the continued demand for Bunnings hardware assets and the valuation increases that we've seen over a long period of time. DIF2 and DIF3 play in that very hot sector being the industrial and logistics market, and they've continued to deliver these returns ever since they were launched. And remember, these are the annual returns delivered by each of the funds on average. So I said at the introduction to today's presentation when I went through the Charter Hall Group that we have over 1,500 properties that Charter Hall is responsible for. That gives us fantastic insight to what are the valuation trends. So this slide, I'll run through the 3 key sectors of office, industrial and logistics, and long WALE and convenience retail, and tell you our views and observations of not just the valuations which happened at 31 December, but also what we're seeing in the investment and occupier markets. For the office sector, investment sentiment continues to improve. There have been significant major recent transactions that have been in excess of the vendors' book values. Valuations, though, have been predominantly driven by capitalisation rate compression, and we are starting to see, and we expect a trend to continue, being the divergence in property yield spreads between prime and secondary assets. So that means that we expect people to be more discerning and focus on the prime assets, and the secondary assets will have a greater divergence in pricing. And on the tenant demand side, we're already noticing the occupier market beginning to rebound, particularly as we get through the Omicron wave and COVID becomes more a part of everyone's day-to-day experiences and the vaccination rates continue to be extremely high. In the industrial and logistics space, well, there continues to be a high level of investor demand. There are structural tailwinds, which I've spoken about many times before, driven by e-commerce, supply chain logistics, as well as demand for essential consumer staples. We expect this to continue. For us, the next part around the industrial story is going to be around what happens with market rental growth. And that's something we do expect to play out over both the short, medium, and longer term. And finally, on the long WALE and convenience retail, for long WALE assets and convenience retail assets, investment demand has been extremely strong. Blue chip tenants such as Bunnings, Coles, Woolworths are highly sought after, driving down capitalisation rates and improving valuation growth. The thing investors like about these assets is they're essential in use. In fact, if you look at things such as standalone and freestanding supermarkets, service stations and Bunnings, they're benefiting from investor demand across all the key capital pools. One of the key strengths of the wider Charter Hall Group is our national presence. It means that we have property and asset managers located on the ground where the assets are held. So I'm talking to you today from our Sydney office, but we have teams in Melbourne, Brisbane, Adelaide and Perth who manage the assets on a day-to-day basis. The reason why that's such an important factor is it means you can get close to your tenant customers, develop strong relationships with leasing agents, and what you can see up here on the screen is some of the leasing success that the team have delivered over the last quarter. You'll see it cuts across a number of funds, and what I've put up here is just the bigger leasing deals. We did many other smaller deals, but I thought putting these ones up shows you how much activity there is in the occupier demand. What you'll also see is the length of lease term. So we engage with our tenants early, we try and create win-win scenarios, and it means we continue to extend and push out that weighted average lease expiry for our funds wherever possible. So I've talked about the performance of the funds on both a 12-month period and since their inception. But what I'll now show is that the fund unit prices have increased. That's not a real surprise because the returns are driven by a combination of income, which is delivered on a quarterly or monthly basis, depending on the fund, as well as capital appreciation. What this slide also shows is we've shown whether they're open or closed and to consider that some are more liquid than others. So every fund has produced strong capital growth over the quarter, and that follows the entire portfolio of assets, all 124 properties being independently valued in the December quarter period. So the first fund I'll talk about in more depth today is the Charter Hall Maxim Property Securities Fund. It's open for investment and it invests into liquid A-REITs, so they're stocks traded on the Australian stock market. It does mean that this fund has a different liquidity profile to the unlisted direct suite of funds. I've already talked about the 12-month returns, and you can see there the 10-year returns as well as the 3-year returns exceed benchmark on an after-fees basis, so across all time horizons. And at Charter Hall Maxim, the team have a high conviction and active management approach, which allows them to favour fundamental investment themes rather than following the broader index. We've taken underweight positions on discretionary retail relative to the index, which has contributed to that outperformance. And the team's expertise in alternative sectors such as childcare, seniors living and accommodation, as well as rural land, have also been key drivers of the enhanced performance. So moving on to the Charter Hall Direct Long WALE Fund, you'll see not just great performance over the 12-month period, but a material change in the portfolio. As the fund's grown and attracted greater equity inflows, we've been able to deploy that into some fantastic acquisitions. In fact, you can see the tenant composition mix up on the screen where we've got government tenants, Bunnings, Coles, the very resilient ALH Group, as well as Primo, accounting for over 50% of the fund's net income. Also pleasingly, we've done some lease extension deals as well as those acquisitions, which have pushed up the weighted average lease expiry to 9 years. The fund still benefits from 100% occupancy, and for investors in this fund, they get their regular distributions on a monthly rather than quarterly basis. So as part of today's presentation, I'm going to spend a little bit more time explaining some of the recent acquisitions across the various funds. The first one I'll run through today is LWF's recent acquisitions of 3 hospitality assets leased to the ALH Group. The thing we like about these is a number of factors, being the long-term leases, so over 14-year weighted average lease term, the occupancy rate at 100%, the lease structure, whereas a landlord, we're not up for the day-to-day running expenses and they're borne by the tenant customer. And at Charter Hall, we like to partner up with the best-in-breed businesses in each of the respective sectors, and ALH clearly fits that description. So for us, being able to acquire and diversify LWS portfolio into 3 long-leased, high-quality hospitality assets really ticks the bill. So the first office fund, which is open for investment and as part of today's presentation, is the PFA fund. It's now got a portfolio of almost $2.5 billion. It's proving extremely resilient in the office market, and a large part of that is the tenant customers we've been able to curate in that portfolio. You can see up there on the screen the top 5 tenants are listed, driven very strongly by the government focus which we've been able to achieve, being federal and state government entities who are paying around 2/3 of the net income of the entire portfolio. The occupancy rate for the fund at 99% significantly outperforms all Property Council of Australia occupancy rates across the various states where the fund owns assets. And if you combine that high level of occupancy with the strong tenant customers, it means the fund has a greater certainty of the income that we'll receive over not just the short term, but the medium to long term as well. And remember, this fund pays distributions to investors on a monthly basis. So continuing today's key focus area on discussing case studies and recent acquisitions, what has PFA acquired in the December quarter? Well, it's purchased 40 Bundas Street in Canberra. It's an A-grade office asset located in the CBD. It was purpose-built for Actua AGL, who's a major owner and operator of electricity and gas networks in the ACT. We like its high occupancy rate at 100%, the long weighted average lease term of 7.8 years, and it benefits from strong environmental credentials, being a 5-star NABERS energy rating. But when we're looking to acquire assets for the funds, we don't just focus on the individual property fundamentals, we also look at the wider market in which they sit. And the Canberra CBD has been one of the strongest performing office markets through the pandemic. And that's because the federal government and the government agencies have continued to lease up space, meaning that that market has had continued strong occupier demand throughout the pandemic. So this gives you a feel for the kind of factors both at a specific asset level and market that we look for when we're trying to curate and improve and grow the portfolio quality over time. Moving on to our flagship office fund, DOF, the Direct Office Fund, has a portfolio of over $3 billion and benefits from a 96% occupancy rate, and just like PFA, has its largest tenant customer being the state and federal government. In fact, the top 5 tenant customers account for 58% of the net income of the fund, and it's delivered strong performance over both the 12 months at 15.4% as well as since inception. The distribution yield for the DOF fund is currently 5.3%, and it has a unit price of $1.74. So what happened with the DOF fund in terms of its portfolio curation? Well, in the December quarter, we're pleased to announce we purchased a part interest in 333 George Street. It's a very high quality office property in a core CBD market, and we like about it, it's defensive and in a highly liquid global gateway city. It means that assets of this standard are in demand not just from Australian wholesale and institutional investors, but offshore pension funds, sovereign wealth funds, and it has a very deep pool of buyers. For those that know the Sydney market well, it's located just at the bottom of Martin Place on George Street and benefits from the light rail which has recently gone in right in front of it. It currently has a 100% occupancy rate. The asset benefits from outstanding environmental credentials. And you get that because the asset was only built approximately 6 years ago, meaning that it's delivered a 5-star NABERS energy rating as well as a 4.5-star NABERS water rating. We are focused on ESG credentials at Charter Hall, not just because it's socially the right thing to do, but because it means the asset is in demand by more tenant customers. So it's a key requirement when big customers come out and they have a brief that the assets that they move into have strong environmental ratings. So this makes the asset much more defensive and in demand from tenants over a longer period of time. I'll now play a short video on 6 Hassel Street, but before I do that, I'll give you a little bit of context around this asset. It's owned by DOF in a 50-50 joint venture with a wholesale investor, and it's one of the more recent acquisitions that DOF has made. And 6 Hassel Street is located in Parramatta, is a world-leading innovation hub right there in the CBD. It's 100% leased to the Western Sydney University and is focused on innovation in the engineering sector, and the precinct is built to create unique opportunities for cross-collaboration and creative inspiration between students, educators and industry professionals. So now we'll play the 6 Hassel Street video. The next in-depth fund update will be on the Charter Hall Direct Industrial Fund number 4, or we love our acronyms in property, DIF4. It's had phenomenal growth over the last few years and now benefits from a $2.5 billion portfolio diversified across approximately 50 assets. It has 100% occupancy and one of the longest weighted average lease expiries of our open funds at 11.2 years. Because it's in the industrial and logistics sector, the tenants tend to be large, but you have more assets, meaning the top 10 tenants in this portfolio account for slightly less than 50% of the income. But like all our funds, we focus on the market leaders, and you can see there Bunnings, Kmart, Visy, Mainfreight, being some very well-known household brands. It's delivered a 21.1% return over the last 12 months and has benefited from some of those strong tailwinds, which I've talked about numerous times, that are benefiting not just the Australian industrial and logistics market, but globally. This is a sector that continues to provide both strong tenant occupier requirements and strong investment demand. And so DIF4 has had a very busy quarter, so I'll only pick one of the assets to talk about that were acquired in the December period. That asset is Bunnings Delacombe in Victoria. It has almost a 10-year WALE or 9.6-year weighted average lease term, 100% occupancy, a fantastic tenant in Bunnings, very resilient. And we like these type of assets because they continue to be in demand from all types of market participants. That's high net wealth investors, listed vehicles, institutional investors, as well as offshore investors. We have a fantastic relationship with the tenant, Bunnings, so we understand their business and their use requirements, as well as always doing our due diligence to make sure these assets will suit them for the longer term. So this recent acquisition builds on DIF4's portfolio of Bunnings, which now represent approximately 8% of the portfolio. So with that, I'll show you a short video on this asset. So it's always good to see it. I know many of you, like myself, spend plenty of time in Bunnings, but they do have different characteristics. So please do enjoy this short video on Bunnings Delacombe. Moving on to the Wholesale Property Series number 1, or WPS1, the first thing I always draw people's attention to is that this is for sophisticated investors only. It has a large minimum investment of $250,000 and it invests into some of Charter Hall's best ideas. It provides access to our high net wealth clients into some of the wholesale funds which the Charter Hall Group manages, as well as the partnerships. These are areas that are typically not within reach of even high net wealth clients. The fund has delivered fantastic returns of 22.9%, benefits from an underlying portfolio with a weighted average lease term of over 10 years, and has a 98% occupancy rate. You can see there from the wagon wheel chart, the sector is pretty well spread between office, industrial and logistics, diversified and long WALE, as well as social infrastructure. And whilst the returns have been fantastic at 22.9%, and it's something we're extremely proud of, I always do like to manage people's expectations. We never highlight that these are returns that you should expect from unlisted funds. Being unlisted funds over a long period of time have delivered returns around that 7 to 10%. So one of the focus areas for the WPS1 fund has been social infrastructure. And we've achieved a 19.5% allocation to this sector. It benefits from an 18.6-year weighted average lease term, and the investment has been made through the Charter Hall Exchange Wholesale Trust, or CHUT. It's a managed unlisted social infrastructure partnership comprising 36 telecommunications exchange properties leased to Telstra Corporation. So again, that very strong and resilient tenant customer. This fund has provided WPS1 with annual weighted average rent reviews linked to CPI, but it's CPI plus 0.5%, providing an inflation hedge to the fund. And the fund's long WALE provides that income security which we're always focused on at Charter Hall. In summary, CHUT is a key part of WPS1's allocation to the social infrastructure sector, and it's something which we believe will continue to deliver for the fund over the medium to longer term. So to round out the WPS1 update, I should also mention that it will close to equity investments in the next 6 months. In fact, the last allotment will be 1 June 2022, and we've had considerably strong investment momentum, and the only reason why we're closing it is in the original information memorandum we highlighted to investors that it would have a defined period when you could invest. But don't worry if you're not well positioned to get into WPS1 yet, because we are shortly launching WPS2. It has a target launch date of April to May this year. It will continue to focus on the 4 sectors of industrial logistics, long WALE retail, social infrastructure, and the office sector. In fact, it will be very similar to the WPS1 product. But as always, we encourage you to read in full the information memorandum when it becomes available, and for those who require advice, please do consult a financial advisor who can advise you on your individual financial circumstances. So for the final case study, I thought it'd be worthwhile talking about an asset sale, because a good manager recognises when the risk-adjusted returns have been maximised, and in those circumstances, we sell assets and return the capital to investors. So for DIF2, it recently sold an asset leased entirely to Inghams, located in Cleveland, Queensland. We achieved a 20% premium above its most recent book value and over a 50% return since we acquired the asset. It manages the exposure to that single tenant, Inghams, and we've returned all the proceeds to investors. But we're always focused on the gearing. So even after the sale of this asset and the capital return, the fund's gearing is right within its target range and currently sitting at about 36%. This is a great example of how Charter Hall will sell assets where we believe it makes sense for the fund and ultimately for the investors in that fund. So I'll now welcome our industry expert for the December quarterly update, Sheridan Ware. Sheridan is the Chief Information and Technology Officer at Charter Hall and oversees the group's technology strategy, operations and change. Sheridan is responsible for driving greater productivity, improved insights and engaging experiences for the group's employees and customers. Prior to Charter Hall, Sheridan spent 11 years at Cushman & Wakefield in roles covering strategy, business transformation and technology across their Asia Pacific business. Please welcome Sheridan. So welcome Sheridan. I'm very interested in this topic, and it's one of the areas where a lot of buzzwords bounce around and I'm constantly hearing the words PropTech. But look, given your experience and breadth across the group in this space, can you give our audience a bit of an explanation on what exactly are we talking about when we say PropTech?
Yeah, I think it's really important just to understand what does PropTech mean, and quite literally it is any technology we use in the way that we buy and sell buildings, how we design and construct those buildings, and also how we manage those buildings on a day-to-day basis. And that's a really growing market. Traditionally speaking, we haven't used a whole lot of technology in the property space, but the amount of money flowing into PropTech companies has tripled in the last 3 years. So we've now got more than $30 billion a year flowing into the PropTech industry. And what is so great about that for us as a property owner is we've got so many different, like thousands, literally thousands of different companies that we can work with to ensure that we're managing our buildings really efficiently and sustainably, that we can provide an amazing experience for anyone coming into those buildings, and that we can deliver information about how these buildings are being used so we can make better decisions.
So would you say that $30 billion that's being put, I've seen charts where there's thousands of these companies, there seems to be a new tech company popping up every week. Is the overall objective to manage the assets more efficiently, to make more money for the funds, or each business is doing different things?
Yeah, look, with all of those options available, I think it becomes really, really important that we don't just focus on the technology and get lost in the technology. We have to keep coming back to what are the actual outcomes that we're trying to deliver for our investors, what are the outcomes we're trying to deliver for our tenant customers, their employees and others coming into our buildings. And for us right now, there's three really core outcomes. The first one is how do we help people return to work and
in a
office
COVID
buildings?
safe way, very
way.
topical.
Yeah, so we've always been really big on how do we create a great experience, including with technology in our buildings. But now we're adding on this additional layer of how do we make sure that's really safe too. Environmental sustainability, I think, is a hot topic for everybody.
The trend's only going one way as well.
And that's a great thing. So how do we use technology to reduce the impact that our buildings have on the planet? And then this is a bit techie, but very much in my space.
Don't lose the audience.
It's cybersecurity. So, I mean, as us as individuals, we can see that we're constantly sort of getting text messages and things from cyber criminals. But that's true in our property portfolio as well. So it's really important we don't just keep the humans safe, we've also got to keep their data safe and the information about those buildings safe. So cybersecurity is.
And look, just on that, something I was quite surprised to see a few years ago where we tried to hire companies to hack in to lifts, the building security systems, because you've got to make sure that you do provide that robust framework because you're protecting the value of the investments here.
Absolutely, and we've got to make sure first and foremost that our buildings are continuously operating, right? And we can't have that impacted by a cyber criminal. So we get hackers to come in and actually try to act like a cyber criminal and see whether they can get into our built environment and cause any damage. So yeah, we're very alert.
So I'm going to go into the COVID area. We're going to keep it brief because I know our audience, you can't open a paper or watch a TV without hearing about it. But in the prop tech space, what have been some of the biggest changes that COVID have driven, particularly as it relates to our portfolio?
Yeah, I think that it's hard to imagine us having got through COVID without technology. So we certainly had to adopt technology that already existed, frankly, in different ways to respond to COVID, whether it was working from home during lockdowns or buying things online because we couldn't go down to the shops to get them. So I think COVID changed not the technology itself, but how quickly we adopted it, and then how quickly our expectation changed that we could do things online. And that's great because the technology was there, we've all adapted to using it. But I think it's also given us an appreciation of the things that technology is just not great for.
And that's right, it really has highlighted that technology can't be a replacement for the human side of things, I guess.
I mean, just coming back into our office has been such a joy, and having that human connection has just been, something that you'll never be able to replace with technology. And I think it was nice to do video chats with our families, wasn't it, during COVID, but there's nothing like a hug.
Yeah.
So I think that technology was great. It helped us get through it. We'll continue to use it, but it's not the be all and end all.
And I think that's a good balancing up around the benefits of technology and how it has improved the way we manage buildings, the outcomes we can deliver for tenants and investors. But I guess what's got you most excited? We're sitting here now, start of 2022. What are you looking most forward to in the prop tech space over the next 12, 18, 24 months?
Do I think we want to capitalise on all the learnings that we've had in this last couple of years and say people do want to adopt technology in different ways. So how can we use technology to take out any mundane work that our people shouldn't be doing because it's better done by a computer, so that they can focus on those really meaningful human interactions with our investors, with our tenant customers, with our building communities.
On that, it probably means there's more time, presumably, to do the value add things, which are going to touch on the things that our tenants value and ultimately improve the investor returns.
Exactly. And that's what we want to focus on, is how do you take out the things that aren't really the best use of our humanness, and by using technology so that we've got more time to do that stuff. And then the other thing is really, trying to use information and put it into the hands of people that need it whenever they need it, whether that's our own team as they're making difficult decisions, or whether it's our customers and having convenient access to the information that they need when they need it. So I think there's loads of possibilities, and we're really excited about the year ahead.
And I hear about data all the time. Everyone in the tech space is gathering up this information. Are we focused on that data side for our buildings, our tenant information, and how do you see us using that information over time?
Absolutely, data is a core focus for us as a business at the moment. And again, it's about the outcomes that we can drive through that data, whether it is the sustainability or whether it's how we can operate the buildings more efficiently so they produce a better return, whether we can measure and manage the occupant experience.
Yep.
We are using it to drive every single outcome. It's kind of the
how
fuel.
you use it, not just data for data's sake.
Absolutely. It's the fuel for other outcomes, but we are laser focused on it.
Okay, fantastic. Well, look, thank you very much, Sheridan. It's been great to hear the focus that Charter Hall has in this space. It's an area that's continuing to evolve, and I guess for the investors and advisors watching today's presentation, you can rest assured that we are focused on improving outcomes from both the tenant customer and investor customer, and PropTech is a key part of that. But as you heard from Sheridan, it's definitely not everything. So thank you very much for coming today,
Thanks for
Sheridan.
having me, Steve.
So this now brings us to the part of today's presentation where I'll answer a number of the questions that have been submitted to us. The first question is in relation to PFA. What information and when can we expect the 5-year liquidity event? Well, I'll cover the end of that question first. So the 5-year liquidity event for PFA is in Q3 this calendar year. So what it means is, as manager, we'll send you more updates on the fund in the March and June quarterly updates, but we will also send you a separate piece of correspondence giving you great information and an update on the fund. And importantly, with these unlisted funds, we always tell people that the 5-year liquidity event is the one to look out for and not focus on the regular limited 6-monthly withdrawal offers. You will also see us as manager, and we do this all the time, we will sell assets where we believe the value has been maximised in anticipation of that liquidity event. But most importantly, we know, having done this many, many times through the last 12 years when I've been at Charter Hall, that the funds will have a very small number of redemption requests, and the funds, just for clarity, will absolutely continue. They are perpetual funds to make sure that we manage them not just for the best interests of exiting investors, but the vast majority of the investors who will elect to continue for a further 5-year investment term. The next question, which we've been sent through, asks, at Charter Hall, are we concerned about rising inflation rates and interest rate levels? Well, the first thing I'd say is at Charter Hall, we never expected the pandemic response, which was dropped interest rates to 0.1%, to continue for the medium to long term. In all our acquisition models, we always factored in the longer term rates through historical averages, as well as a forward-looking interest rate curve. So we're not surprised that as you move through a pandemic, as the economy recovers, that interest rates will go up. Inflation hasn't been in the RBA's range until very recently of the 2 to 3% for a long period of time. Just the other day, the RBA governor highlighted that he's still of the view, and the board of the RBA is still of the view, that the interest rate rises and inflation won't be as elevated as what the market is pricing in. In any event, real estate and commercial property is an excellent inflation hedge. If the economic conditions continue to improve, it typically leads to higher market rents, and that is a good thing for investors. So the other thing I would highlight is the weighted average rent reviews that we have in all the leases. So for our office funds, DOF and PFA, the annual weighted average rent review in both funds is over 3% and close to 3.5%, meaning each year you do get that increase in income. That's a fantastic inflation protection to have. A number of the leases have CPI index or CPI plus a percentage. And I would highlight, if this is something you want to know more about, there's an excellent article which our research team, as well as external sources, has pulled together for the December quarterly report. So I could talk about this topic for a long period of time, but probably a great segue to look at that quarterly report. There's some great graphs in there around the increased allocations to real estate, which will also have impacts on the investment side of the market. The next question is very short and succinct. When will office markets improve? Well, look, as we stand here now, the Omicron variant is still racing through the community. But what's been clear is that the tenant occupier markets are already starting to come through the other side. So the sublease space on the market continues to reduce. You're seeing more confidence as vaccination rates, as I said earlier, are higher, that people will be getting back to the office. And some of that talk around the start of the pandemic around working from home being something that everyone does on a permanent basis, that's definitely going away. As we get through 2 years of disrupted conditions, it's become more evident to the leaders in these businesses that getting your people together in a collaborative environment is the best way to drive your business and ultimately drive your profitability and returns. So what I would say is, I think we're well there, we're closer to the end than the start. And what I would also say is some of the largest, most sophisticated wholesale investors in the world are actively targeting the key markets on the eastern seaboard in Australia, your Brisbane, Sydney, Melbourne office markets, and the prices that they've been willing to pay for those assets reflects the strong confidence that these sophisticated investors have in the office market for the long term. And now the final question which we've been sent through is, are we concerned about our ability to continue to source high quality assets at the right pricing for our open funds? Well, the simple answer to that is no, we're not concerned. It doesn't mean we don't work extremely hard to secure the right assets, but at Charter Hall, we're very lucky to have the largest transaction team in the market. Because we are multi-sector specialists across office, industrial and retail, social infrastructure, it means that we're talking to tenants in many different locations across different levels. We're shown many opportunities off market which don't even hit the market. So this is a key benefit of the wider Charter Hall group and the relationships which we bring. And as you've hopefully seen today when I went through those case studies on the acquisitions, the key metrics are absolutely in line with what the PDSs or the information memorandums of those funds are, which is long-term leases, high quality institutional grade property, high levels of occupancy, and that long weighted average lease term. So I think you can expect some more high quality acquisitions across the funds, but as the funds grow and we continue to raise money, you will also see us regularly sell assets where we believe the value's been maximised. And you heard that today when I talked about DIF2 selling its Ingham's Queensland asset. So because we are limited by time at these quarterly events, unfortunately that's all the time I'll have to answer questions. But if you've sent through something or you have something that's come up today that you'd like further information on, I do encourage you to reach out to the team whose contact details will be shown up on the screen at the end of today's session. That concludes our update for the December 2021 quarter. Thank you for joining me today. I hope you've gained some insights into our funds and the Australian commercial property market more generally. As I've just said, if you have any other questions or would like to reach out to the team, their contact details are up there on the screen and they're always happy to assist. Thank you very much.